Warren Buffett bought his first stock when he was just 11 years old. It was a monumental moment for the young boy, marking the beginning of a lifelong journey into the world of finance and investment. He was fascinated by the idea of owning a piece of a company. The concept of being a part owner of a business, no matter how small, intrigued him deeply. It wasn't just about the money, it was about understanding how businesses worked and how they could grow. Young Warren diligently saved his money. Every penny he earned was carefully put away, with a clear goal in mind. He understood the importance of saving early on, a lesson that would serve him well throughout his life. He even had a paper route to earn extra cash. Every morning, he would wake up early, rain or shine, to deliver newspapers to his neighbors. This job not only provided him with additional income but also taught him the value of hard work and responsibility. He saw investing as a way to grow his savings. Instead of spending his money on toys or other fleeting pleasures, he chose to invest it, understanding that this was a way to make his money work for him. Even as a kid, he was always looking for ways to make money. Whether it was setting up a lemonade stand, selling items door to door, or mowing lawns, young Warren was always on the lookout for new opportunities to earn. He sold Coca-Cola bottles and delivered newspapers. These small ventures were not just about making money, they were about learning the basics of business, understanding supply and demand, and honing his entrepreneurial skills. He even ran his own small businesses, like a pinball machine operation. This venture was particularly successful, teaching him valuable lessons about investment, maintenance, and customer satisfaction. Buffett's early experiences taught him the value of hard work and saving. These lessons were ingrained in him from a young age, shaping his future approach to business and investment. They also sparked his interest in the world of business and investing. Reading business magazines and keeping up with stock market news became a regular part of his routine, further fueling his passion for finance. These early experiences laid the foundation for what would become one of the most successful investment careers in history. Like anyone starting out, Buffett made some mistakes early on. These early missteps were crucial in shaping his future investment philosophy and strategies. One of his first investments was in a company called Citi Service Preferred. At the time, Buffett was just beginning to dip his toes into the complex world of stock markets. He was excited when the stock price went up. The initial surge in the stock's value gave him a sense of accomplishment and validation, but he got scared when it dropped and sold too soon. The sudden decline in the stock's price triggered a wave of fear and uncertainty. He missed out on bigger profits when the price later rebounded. This missed opportunity was a hard pill to swallow, but it was also a pivotal learning moment. This experience taught him a valuable lesson. It underscored the importance of not letting emotions dictate investment decisions. Don't panic and sell just because the market is down. Instead, it's crucial to stay calm and stick to your investment strategy. It also highlighted the importance of patience and discipline in investing. These qualities are essential for weathering the inevitable ups and downs of the market. This was a crucial turning point for Buffett. It marked the beginning of his journey towards becoming a disciplined and patient investor. It led him to seek out a more structured and disciplined approach to investing. He began to develop a comprehensive investment plan, focusing on long-term gains rather than short-term fluctuations. Buffett started to immerse himself in the principles of value investing, studying the works of Benjamin Graham and other financial experts. He attended seminars, engaged with other investors, and continuously refined his strategies. This relentless pursuit of knowledge and improvement became a hallmark of his investment career. Over time, these efforts paid off. Buffett's disciplined approach and commitment to value investing principles led to significant success and established him as one of the greatest investors of all time. Buffett's investment philosophy was deeply influenced by Benjamin Graham's book, The Intelligent Investor. He read it when he was 19 years old, and it was a game changer. Graham's book taught him to look at stocks differently. Don't just focus on the stock price, Graham argued. Instead, think of stocks as ownership in actual businesses. This idea was revolutionary for Buffett. It shifted his perspective from a speculator trying to predict stock prices to an owner seeking long-term value. This became the cornerstone of his investment strategy. Buy good companies at reasonable prices and hold them for the long haul. Graham's first key principle was to think of stocks as parts of a business. When you buy a stock, you're not just buying a piece of paper. You're buying a small ownership stake in that company. This means you should approach stock picking the same way you would approach buying a whole business. Would you buy the entire company at that price? This concept encourages investors to look beyond short-term stock price fluctuations. It emphasizes understanding the underlying business, its profitability, and its future potential. This long-term perspective is fundamental to Buffett's investment philosophy. Section 5. Beyond numbers. Understanding the business you own. To understand a business, you need to look beyond just the financials. Read the company's annual reports. Look at their products or services. What are their competitive advantages? Who are their competitors? Do they have a strong brand? How is the management team? Buffett emphasizes the importance of investing in businesses that you understand. If you can't explain how a company makes money in simple terms, then you probably shouldn't invest in it. This approach ensures that you are making informed decisions based on a thorough understanding of the businesses you own. Section 6. Rule number 2, Mr. Market and the emotional roller coaster. Graham introduced the concept of Mr. Market to explain how emotions can drive stock prices. Imagine Mr. Market is a person who offers to buy or sell you stocks every day. Sometimes he's manic and will offer you a high price. Other times he's depressed and will sell low. The key is to not let Mr. Market dictate your actions. Don't get caught up in the daily swings of the stock market. Instead, focus on the underlying value of the businesses you own. This requires emotional discipline and a long-term perspective. Section 7. Keeping your cool when others panic. When the market goes down, it's easy to get scared. But this is often the best time to buy good companies at bargain prices. Remember, Mr. Market is offering you a sale. On the other hand, when the market is euphoric, it's tempting to buy everything in sight. But this is when you need to be cautious and not overpay. Buffett's approach teaches investors to be fearful when others are greedy and greedy when others are fearful. This contrarian mindset allows you to capitalize on market fluctuations and acquire undervalued assets. Section 8. Rule number 3, the safety net of margin of safety. The margin of safety is the difference between a company's intrinsic value and its market price. It's like buying $1 for 50 cents. The bigger the discount, the bigger your margin of safety. This protects you if your analysis of the business turns out to be wrong. Even the best investors make mistakes. The margin of safety provides a cushion to absorb those errors. It ensures that even if your estimations are slightly off, you are still buying the asset at a price that offers a good return potential. Section 9. Competitive advantage, the moat around the business. Buffett looks for companies with a moat around them. This refers to a durable competitive advantage that protects them from fierce competition. Think of businesses like Coca-Cola with its strong brand recognition or railroads with their extensive infrastructure. These advantages make it hard for new companies to steal their valuable market share. A strong competitive advantage allows companies to maintain higher profits and market share over the long term. This in turn translates into sustainable growth and better returns for investors. Section 10. Management matters. Captains of the ship. Finally, Buffett pays close attention to management. He wants to see honest and competent leaders who are good stewards of the company's capital. He looks for managers who are passionate about their business and have a long-term vision. Good management is crucial for a company's overall success. They make strategic decisions, allocate capital effectively, and navigate challenges. Investing in companies with strong and ethical management teams increases the likelihood of favorable outcomes. Section 11. Building wealth the Buffett way. By following these simple principles, Warren Buffett has become one of the wealthiest people in the world. His journey is a testament to the power of consistent, disciplined investing. Buffett's approach is not about quick wins or speculative bets. It's about understanding the true value of a business and investing in it for the long haul. He's proof that you don't need to be a Wall Street genius to be a successful investor. Instead, what you need is a clear strategy, a willingness to learn, and the patience to see your investments grow over time. Buffett's success is built on principles that are accessible to anyone willing to put in the effort. You just need a solid understanding of how businesses work, a long-term perspective, and the discipline to stick to your plan. This means doing your homework, understanding the fundamentals of the companies you invest in, and not getting swayed by short-term market fluctuations. It's about seeing the bigger picture and staying the course even when the market is volatile. Buffett's investment philosophy provides a roadmap for beginners. It demystifies the process of investing and makes it approachable. By focusing on companies with strong fundamentals and holding on to them for the long term, even novice investors can achieve significant success. It emphasizes patience, discipline, and a focus on intrinsic value rather than market noise. This means looking beyond the daily ups and downs of the stock market and concentrating on the underlying value of your investments. Patience is key, as true value often takes time to be realized. By adopting these principles, investors can make more informed decisions and build a solid foundation for long-term wealth creation. It's not about getting rich overnight, but about building wealth steadily and surely over time. With Buffett's principles as your guide, you can navigate the complexities of the stock market and achieve financial